Hello everyone, welcome to JMac Investing. My name is Jason. Thanks for tuning in to another episode. And this one we're going to cover a few of the best monthly dividend paying ETFs. I've covered the best ETFs overall, whether they were monthly or quarterly or whatever, in another series. This one we're going to get down to the granular level of the best of the group of those that pay monthly. Stay tuned. Alright, so I hope this video finds you well. I hope everyone is having a great weekend. So I just wanted to kind of break down how I'm going to approach this. So I'm essentially, in this one, I'm only going to compare and contrast 3 monthly paying ETFs that are all equity based, because there's a lot of bond ETFs that pay monthly, but I'm looking at ones that hold stocks as the asset backing the ETF, and that they pay a monthly dividend amount. But this is factoring in, if you invested $1,000 into this ETF, how would your money perform, including the reinvestment of dividends, right? So I think a lot of people that are newer investors and or people who haven't really done their due diligence and research get involved into ETFs and stocks based on yield alone, not thinking about the overall dollar amount, because the money that you make off of stocks and equities and assets is, at the end of the day, doesn't matter if it's in the form of a cash paid to you right now. That's what we're going to do. I want to show you. So if you invested $1,000 into this ETF, how much would that return you with dividends and capital appreciation? Never ever leave the capital appreciation out of your equation when you're looking for stocks or ETFs. So, and really what makes a good ETF is an ETF made up of good companies. So let's look at the three that we're going to look at today are DGRW, SPLV, and SPHD. Let's check them out. So here, taking a look at Wisdom Tree Trust U.S. Quality Dividend Growth Fund, ticker symbol DGRW, currently priced at $42.24, current yield of 2.75%, distribution yield, and expense ratio 0.28%. You look at the analyst ratings on it, it's A-rated, has a 9.7 out of 10 by XTF company that rates ETFs. Net Davis Research Group gives it a 4 out of 5 star. Morningstar has it 4 out of 5 stars. And so we can go down here and you can see here's its overall performance. Amazing, incredible. And then they give us some comparisons. But what you really want to do is you want to look at the holdings. What is this thing made up of? So its top holdings are Verizon makes up about 6% almost. Microsoft's 5.3%. Apple is 4.84%. Procter & Gamble 4.34%. Merck 3.5%. Pepsi 3.2%. Altria Group 3%. Intel 2.62%. United Health Group, BMY. I would own every single one of these companies. These are all amazing companies, and you can see there is 279 holdings in this. Let's break it down. They're all North American companies. The market cap, large cap weighted by 87%, mid cap 9%, small cap 3%. So you get a little bit of small cap exposure here, a little bit of mid cap, mostly large cap. Sector and industry, this is what I really like. So this is a rare ETF that is tech heavy, 23%, healthcare heavy. These two are what is going to drive growth over the next coming year or two because of what's going on. So this is the reason I'm investing into this ETF for my wife. And then this industrial heavy, which is great. Consumer staples heavy. So these are great sectors that I want to be heavy on, right? And then real estate's at the bottom. of this one. So that gives you just a high level overview. I mean, if you wanted to dig deeper, you could click this and you could go into, but I think this gives you enough to see the high quality companies this ETF holds. Let's jump over and look at the next one, SPLV. All right, so here we have Invesco S&P 500 low volatility ETF. SPLV has a distribution yield of 2.72% and an expense ratio 0.25%. Let's check out their analyst rated an A. Morningstar's got it at a 5 out of 5. Net Davis has it 3.2, and XTF Inc. has it 9.1. So this is probably right on par as far as analysts rating it with DGRW. And you can see its chart here. Looks pretty good. There's some competitors. Top 10 holdings: Walmart, Citrix, Eversource Energy, Duke. So utility heavy, fairly heavy utilities here. Consolidated Edison, Pepsi, Public Service Enterprise, Atmos Energy, WEC Energy, XL Energy, a lot of utilities, and then some good consumer staples at the top here. And it only has 101 holdings, so less diversified for sure than DGRW. And so you get 97% North American assets, 2.3% European. Market cap weighting: large cap 66, mid 30, small 3. Here is how I look at the sector. So utility heavy, which I think that was why it's kind of considered low volatility, although utilities have taken a beating of recent because with the economies, global economies being shut down, energy consumption, utility and power is gone way down. And then it also, which real estate, it was not low volatility right now. Let me tell you, real estate is very volatile. Financials are really volatile. So the reason you think you would buy this for the safety and security of this particular ETF is all out the window because of the current state of the really the globe right now. So this, in my opinion, just off of the sectors that are the sector heavy part of this ETF, I do not like it being heavy utilities, real estate, and financials. It is not my cup of tea. So healthcare and tech are way down the list. So here we go. We got SPHD, Invesco, S&P 500, high dividend, low volatility. That's what they say it is. I totally disagree off the bat. I'm going to tell you this is probably the one of the worst performing ETFs on the market. Well, ones that's probably one of the worst performing that's very popular. So you can see 52 week, it's terrible. Down still 25%. No rating by FactSet. 3 out of 5 Morningstar. 2.8 out of 5 by Net Davis, and 7.7. So for sure, analysts agree with me that it's not a very good ETF. And here's your chart. Yeah, it's way down. And here's your top holdings in this. This is why it's bad and why I don't like it. Williams Company top. I like Altria Group and Gilead. I like Iron Mountain, not so much. Philip Morris is okay. IBM, middle of the road. Progressive, it's okay. General Mills, good. Dominion, good. AT&T, meh. And it's only 51 holdings. So these are all meh, a bunch of meh companies, honestly. So regional exposure, there's no Microsoft, Verizon, Pepsi, J&J. There's no real high quality companies in this list. So buyer beware. North America 98%, Europe 1.7. I guess that Philip Morris is probably makes up a lot of that regional exposure there. Market cap, large cap 57%, 34 mid, 8% small cap. Checking out the sectors. Real estate, again, real estate and utilities are top of the list, which is terrible right now. Consumer staples, financials, really consumer staples is the only one I don't mind being heavy on. Energy 10% heavy. Terrible. So, and IT all the way down at the bottom. Not my cup of tea, not interested, no thank you, no money going in. But since many of you love it and you love losing money, we're going to throw it in, and I'm going to show you that you lose money investing in SPHD. Now we're going to switch over and we're going to run a back test against these three and see how they performed if you invested $1,000 into them. Okay, here we are using a tool that I love to use, which is a back test. Portfolio Asset Allocation. It's portfoliovisualizer.com is the website if you'd like to use it yourself. All right, so I'll show you how we got this set up. We got the time period set on month to month so we can maximize the time frame of when we start and when we finish. And it only goes back to 85, so we'll have that set to the current year. And then the initial amount, I dropped it down. Usually by default it puts $10,000 in. I dropped it down to having an initial amount invested, so your initial money put into this was $1,000, and we're doing display income, yes, and that reinvest dividends. So rebalance annually, let's do no rebalancing. Okay, and so there we go. So we're not rebalancing, we're just reinvesting dividends. So we got DGRW as portfolio number 1, we got SPLV as portfolio number 2, and then we got SPHD as portfolio number 3. And let's analyze. So here we go. So you can see 100% in each portfolio. And then we get down here into the portfolio returns. The $1,000 in portfolio 1, which is DGRW. So this one is DGRW, returns you $1,830 for a compound annual growth rate. So it was earning is since inception, which it goes back to 2013. So your annual return on DGRW is 9.24%. Your annual return on SPLV is 8.71%. So the portfolio 1 DGRW, portfolio 2 is SPLV, portfolio 3 is the terrible ETF that people love, SPHD. So the $1,000 invested in SPHD would have made you $1,400, $300 less, and $400 less. So, and you can see, so this one SPHD says low volatility, but you know, look, its worst drawdown is 30%. The DGRW, which SPLV also has low volatility in its name, but DGRW is the least volatile of them all. So its max drawdown is only 19%, and that's what that looks like. And this shows you your annual returns, and then this shows you your portfolio income, how much you would have over time. And yes, you'd have more income with SPHD, but that's factored into this total return. So the total return, it does factor in and includes the dividends that have been reinvested. So as you can see, if you like 5% returns overall, invest in SPHD. If you like 8 to 9% returns, invest in DGRW or SPLV. So there you go, guys. One more thing, I did have one subscriber asked me to include, I will display it here real quick. So I had a subscriber, Tommy Ron, ask, any chance you could add some of the Global X monthly dividend ETFs like DIV, SDIV, and SREIT to that monthly ETF video? Thanks, man. Great content. Keep it coming. Capital appreciation has been non-existent, but yield is way up there. Could be a great opportunity in these funds at these market crash low prices for income investors willing to hold for forever. Okay, Tommy, so I'm not going to run it against these other ETFs because it's definitely not my cup of tea type of ETF, and one that I would not invest money in. But just for your benefit and for the benefit of the viewers, I'll run those together and we can see how terrible the returns are on those. Sorry to put it that way, but it's 100% true. It's been a very bad performance by these ETFs. So let's take a look. So here we go. We got $1,000, set it to month. We'll do rebalance, no rebalancing, reinvesting dividends, yes. So we got DIV, which is the Global X Super Dividend This one's another one, a Global X Super Dividend ETF, and SREIT, another one, Global X Super Dividend. So 100, 100, 100. So, and let's analyze. And you can see, so these guys would have lost you a bunch of money. So if you invested $1,000 right now, including dividends being reinvested, you would have lost $351 in that one, $417 in that one, and you would have lost $59 in that one. So you just be bleeding. So there you go. That's not an opportunity. That's a opportunity to lose money. If you like losing money, invest into Global X. If you like making minimal gains, invest in SPHD. If you like to invest in premier assets, invest in DGRW and SPLV. That's all I got, guys. Till next time, deuces.